So for more than 18 months now, the stock market has been on a tremendous run, and Montaka's performance has been outstanding too. Over this period, our Mogul fund is up 80%, and the MSCI market index is up 40% in Australian dollar terms. Now, while most investors are delighted by the results, some are also uneasy about what comes next. Many have concerns about whether the market has risen too fast too soon, if it's become too concentrated in just a handful of stocks, and if the portfolio still offers the excellent value that it did previously. So, in our latest quarterly letter, we took the opportunity to go deeper into these issues. Now, first, we examined the current market dynamics, and we found that they're quite reasonable, especially when viewed in the proper historical and structural context. Yeah, of course, stocks have rallied strongly again this year, and volatility has remained remarkably low. But under the hood, the market's bifurcated into winners and losers. And the winners have been a handful of big tech leaders that have driven almost 60% of the market's gain this year. Now that's striking, but it's also quite typical. For example, we know that just 4% of stocks accounted for all the $35 trillion of wealth created in the US stock market over the last century. It's also not surprising to see the big tech companies are dominating the market. And that's something that we went deeper into not so long ago in a recent article that we've linked to below. Now, if we step back, you can see that the price gains that have happened this year just aren't as dramatic as they first seem either. Sure, the Magnificent Seven tech stocks are up 31% in the first half, but that's only 11% per annum above their peaks just before the 2022 market sell-off. And if you take out Nvidia, that falls to just 2%. And we're seeing the same dynamics in our portfolio too. For example, Amazon, which is our top holding, was up 27% in the first half, but it's only just got back to its previous high that it set 3 years ago. And KKR, our second biggest holding, well, it was up 27% in the last 6 months too, but that converts to a 9% per annum return from its prior peak. By the way, the letter includes a fascinating piece that explores the parallels between KKR and Warren Buffett's own Berkshire Hathaway, so be sure to read that one too. And look, even more importantly, when we went and examined our portfolio, we found that it offers fantastic long-term value. Now, we took a different approach to multiples valuation than you typically see, where a company's share price is compared to its earnings 1 year ahead. And instead, we compared the current share prices with estimated earnings 5 years from now. And we can do this because it makes sense to look well beyond the next year for companies in our portfolio that can strongly compound their earnings power with a very high degree of certainty. And what we found was that the top portfolio holdings are actually trading on quite low multiples of their long-term earnings power. For example, Amazon trades at 9 times, KKR's on 11 times, and Spotify's on just 9 times earnings as well. Now, finally, we've been asked if we're changing the portfolio, either to protect against a temporary pullback or to benefit from the next move in the markets. Instead, we've largely left the portfolio unchanged, especially amongst the top holdings. And that's because the portfolio looks like it's offering excellent growth and value over the longer term. And we remain confident that it will create far greater value in the future than it already has today. So thank you for trusting us to protect and to grow your wealth, and we'll see you again next quarter. Bye for now.